Good afternoon, everybody. Uneducated Economist here. So in this video, we are going to be talking about how the Federal Reserve is going to be forced into cutting rates going into the future or the very near future. A lot of people are believing this due to the recessionary pressures that are building. A lot of people are under the belief that we are going to see high unemployment and inflation at the exact same time, which is going to put the Federal Reserve in a terrible bind. Now, they have a dual mandate, which says that they are to try and maintain an economy that has low inflation with stable prices and full employment, or what I guess a lot of people would say low unemployment. It's no definition to exactly what that is. But when you think about an economy operating at its potential with low inflation with stable prices and low employment, this is what the Federal Reserve is ultimately looking for. And any deviation from that, the Federal Reserve is going to have to react to that deviation. So ultimately, going into the future, if we see a recessionary pressure that causes the unemployment to rise significantly, well, then we would assume that the Federal Reserve would try to combat that with the lowering of interest rates to try and stimulate some economic activity and hopefully get some business investment started to ultimately hire those people, to lower the unemployment. That would be the ultimate goal of the Federal Reserve with the lowering of interest rates, or at least that's what most people would assume or believe coming from the Federal Reserve. But then at the same time, if they have high inflation, the way they combat the high inflation is with elevated interest rates. So here you have a combating situation in which that the Federal Reserve's dual mandate may be moving in opposite directions from each other, leaving them in this what do we do, this dilemma kind of situation. Now, there was a lot of clarity that came out in Waller's speech yesterday. Now, I wouldn't say that by listening to Waller, you're going to get an idea of what the entire FOMC is saying. Although a lot of people would even read the headline that says the Federal Reserve, talking about the Federal Reserve in a particular condition, and then refer to what Waller was saying. Now, Christopher Waller is a voting member of the FOMC, but he is not the complete decision maker of the Federal Reserve. He's just a decision maker over his one vote. Goes along with 11 other votes from the FOMC that dictate monetary policy, but understanding his position gives you a much better understanding of how it is that the FOMC is discussing this issue. Now, really, in that speech that he gave yesterday, he really came down to 2 points, 2 scenarios that he was talking about, right? The tale of two stories, 2 scenarios. One of them is with elevated tariffs causing elevated inflation of the higher proportion. And then there's the second scenario where a lot of the tariffs that we are now believing are going to be impacting the economy end up getting alleviated through negotiations or workarounds or exemptions or whatever it is that's happening out there, basically not getting the full impact of the tariffs that a lot of people are believing are taking place at this time. So basically, the negotiations alleviate a lot of the tariffs. This is scenario number 2. In the first scenario, he talks about it in an extreme fashion, some major tariffs, some major inflation that is coming, and that would impact the economy to the point that the estimated idea of where it would go would be, that of 5% or more on the inflationary scenario, which is quite elevated and would force the Federal Reserve to have to act in a way that would be counterintuitive to the idea of lowering rates, right? This is not something that, if that scenario was to take place, that wouldn't encourage them to want to lower rates. But in the scenario number 2, where the tariffs are not as powerful or as present or impactful as people believe, the tariffs are alleviated in a lot of ways. Well, in the scenario number 2, and the inflation is elevated up to 3%, which is higher than we are today, but then this estimate is just an estimate. There's nobody, you can't tell exactly where it's going to be. But in the speech and the way that he was describing this situation, if you're at a 3% inflation rate, and you have unemployment that's rising, the risk of recession is outweighing that of inflation. And so therefore, if you have like a situation in which that the recessionary pressures are building, forcing the unemployment to go up, that would be more of a critical issue for them than the inflationary scenario. So ultimately, in the idea of what is to come in the future, if we have very high inflation due to the impacts of a dramatic tariffs or something hitting the economy, you can most likely anticipate that the Federal Reserve is going to have to deal with the fact that the inflation is elevated, which most likely means that they are not going to be cutting as dramatically as people would assume. Right? But then on the other side of that, if you have a dramatic rise in unemployment, then this would ultimately be the risk, more risk for the Federal Reserve and their mandate than it is on the inflation side of things. So going into the future, will they cut? Will they not cut? Well, me personally, I'm watching the unemployment rate. If the unemployment rate starts to rise significantly, then I would assume that yes, they are going to have to act in a way that would hopefully have the monetary policy being stimulating enough to actually bring the unemployment rate down, which means that you would have to have business investment and people out there buying houses and cars and going on vacation, basically producing consumer aggregate demand, out there in order to create the economic environment in which that those businesses would want to hire those employees to bring that unemployment rate down. Again, like all this stuff is very like what if, gotta wait and see, data dependent. There's no way of telling exactly what it is that's going to happen, especially when you have the idea of the uncertainty behind trade, like the negotiations, like what tariff is it that we're really going to be facing. Once we have all that information, well, then the clarity is probably going to be very much of one that this is not the big deal in which that a lot of people had made it out to be. I mean, you think about it, even already you can see how the dramatic tariffs have been like alleviated. Like, it was going to be day one, 30 days, April 2nd, Liberation Day, all the other stuff. Well, every time the news comes out, it seems there's less and less and less tariffs that are being set and actually forced into the economy. At first, people had internalized it. Oh man, this is big. This is really happening. But then as time goes on, each day we're getting a little bit more, understanding that the tariffs are postponed, that there's workarounds, that there's exemptions, that there's negotiations, and all this stuff is creating so much uncertainty within the market. It makes it very difficult to understand what is it that is happening out here in the economy. Are things active? Are people participating? Is unemployment rising significantly? Do we have a recessionary pressure building? There is no clarity that is being like pushed out there to the mainstream media, but the idea of uncertainty has been ripping. Like they push uncertainty and the word uncertainty. Just go and look for that word. Uncertainty inside of the news articles, and just about every single article you're reading right now has at one point or another included the word uncertainty within it, because that's literally the power that they are using by keeping the people confused and no way knowing exactly what the outcome is going to be. They can then use their words to guide the markets in a more profound way, because people, if you're very certain, then you're not going to listen to them like, hey man, like whatever. I mean, whatever you say, that's cool. I'm pretty certain on what it is that's going on. But if you're uncertain, you're going to hang on every word to try and find the certainty, right? To try and find out what the outcome is really going to be. What is this that's happening? So again, like as we look at the news, as we look at the situation that we are facing right now, as people are thinking and believing this, it's like, okay, are they going to cut? What will happen going into the future? Well, if you're under the idea that they are going to cut, you have to watch the unemployment rate, because that's going to be the indication. If that thing starts to rise, then your hopes for an interest rate cut are probably going to be moving up, right? But here's the kicker about the whole thing. It doesn't really matter what cut they do. Like, it doesn't matter when or how much. What matters is the delivery of the message that comes with it. because that delivery of the message is going to have a profound impact on the markets and how it is that they react to that message. The ultimately the cut itself, like the interest rate adjustment itself, takes anywhere from 6 months to a year. So as people get very excited, are they going to cut at the next rate? And I'm thinking, why? Do you plan on doing something 6 months from now or a year from now? Because that's when the rates are really going to start impacting the economy. You think about it, people get excited about the idea of lowering interest rates to have mortgage rates, like the mortgage loans be cheaper for the buyer. People get very excited about this and they say, is the Fed going to cut? Is the Fed going to cut? Because I want to be able to buy a house with a cheaper interest rate on the mortgage. And I'm thinking to myself, it doesn't matter what the Fed does, because even if they cut, it doesn't necessarily mean that the mortgage rates are going to come down. I mean, just think about it. In 2023, at the end of 2023, the Federal Reserve delivered a message that said that they were going to be cutting in an extreme fashion. Now, that message that they delivered was very open-ended because it was the dot plot that people were looking at. So here the FOMC, right, they look at it's a statement on economic projections. So they look at the economy and they say, okay, here's the condition that we are in today. If this condition was to continue, this is what we would need to do with our interest rates. The problem that most people look at that is they say this is a guideline of what they plan to do for the future. That is not accurate. That is not the accurate way of looking at the dot plot. The dot plot is basically saying if this situation within the economy was to be the same in the months ahead, we would be doing this with the interest rate adjustments. Here's the problem. The economy never, ever, ever stays the same. So that statement on economic projections is literally just it's almost as if it was just an imaginary number, because they know, like everybody knows, that the economy is not going to be the same. There's not going to be the same conditions, not next month, not next week, certainly not in 6 months, right, or a year from now. So to believe that there is going to be some kind of major interest rate cut going into the future from the dot plot is very illogical. However, when the news is presented in this fashion that they are going to be planning on cuts, they committed to this cut, they are planning, doing, definitely happening, right? Like you have this news that is projected out there to the people, they then start internalizing this information as if that interest rate cut is a guarantee, and then they start acting accordingly. So here we had 2023 statements saying that there was going to be all this interest rate cuts going into 2024. The mortgage rates literally were ticking down to the moment that they cut. And when they cut, they delivered it with the message that this is almost like an emergency rate cut, right? Because it was a 0.5 percentage point, which was very dramatic, much more than what people were anticipated. They thought for sure they were doing it because of weakness in the economy, because of the unemployment rising, because of these issues. They thought for recessionary pressures. And many economists believed because of this major interest rate cut that they were going to be doing, that there was like recession on the way, that they would soon be taking interest rates all the way to zero. Well, when you have such fear, uncertainty, and doubt being presented with those interest rate cuts, people were like, whoa, man, I don't want to tie my money up right now. If we got recession going on, I'm demanding a higher return for my capital investments. And you saw the mortgage rates start to move up. Quite opposite of the Federal Reserve's Fed funds rates, right? Because of the message that was delivered with it. Then they delivered 2 more rate cuts, quarter-point rate cuts, but the message that was delivered with it was one of general support for the economy and not necessarily one of like recessionary pressures that we're building. It was just a general support for the economy. And what did we end up seeing with mortgage rates after that message was delivered? They slowly started to tick back down, right? They didn't come down dramatically, but they were ticking down. Right? Again, delivered on the message. The first time they cut rates, it was delivered with the message of weakness and mortgage rates shot up. The second rate cuts were delivered with the message of general support and the rates started coming back down, because people think, okay, if you cut the rates and it's for general support for the economy, that's going to have inflationary pressures that build from it. Okay? That's what starts causing the interest rates to move up. They can do the action all they want. Okay? It's not the important part. It is 6 months to a year down the road. That's when that really starts to kick in. But the immediate effect to the markets is from the delivery of the message of how and why they are doing it. Right? Once you see that, then the interest rate adjustment is not the big deal. You're waiting and hanging on the words to listen to how they are delivering the message. Are they doing it because they need to support the economy because of recessionary pressures? Or is it general like supportive action? Because if it's a general supportive action, you're going to have inflationary pressures built from it. If they're doing it because of recessionary pressures, then generally you're going to see the inflationary pressures come down. Okay. Anyways, we got 510 people watching with 71 likes. Thank you so much for hitting that like button. Let's go through some of these comments and see what you guys have to say. We got Brody up in the house. Thank you so much for being here and all the hard work you do for the channel, man. All right. On top of that, any attorney who has represented clients that were protesting in support of Palestine was detained when coming back from vacation. Wake up, people. Trump's tariffs target is off by $1.5 billion a day. It's too late. The damage has already been done. The damage is irreversible. All right. Have to do something to stimulate movement. It's reversible, but not in the short term. Add that to the bond rates actually increasing despite stock crash. Reversible. All right, the crew's up here. All the desirable homes in desirable places are at a sub-3 interest rate. So I don't care what the rates are. The prices are the barrier. The unemployment rate is in the 4s. No cuts are coming. All right. Buy tariff mentality will reduce housing supply. No. Just started my truck. I'll be in ear candy mode. Right on. Great to see you, all-nighter. All right. Smoke that thumbs up like Cheech and Chong. Does Europe own America? Gold and silver money fixes all. Actually, John, it doesn't. Like, it does for the individual person who may be loaded up on gold and silver and sitting in a position in which that they have excluded themselves from a third-party claim. And you have enough of that position in a network to deal with it. But for the most part, if you were to return a gold standard to the United States, we would all fall into misery and poverty almost instantaneously, as our luxurious way of life is far too expensive for us to afford. Gold and silver would then be exported to the foreign producers of the items that we import into the United States, and all the gold would vanish almost immediately. So no, gold and silver doesn't fix anything. In fact, it makes the problem even worse. You personally, I believe, like me personally, that's when not you, me personally, I think holding gold and silver as a personal possession, a speculation, and an insurance policy to be outside of that third-party claim is an excellent way to go. But to force the economy, the American economy, into a gold standard would literally be writing our own death sentence. Don't wish for it. If you believe that, go and study Cantillon effect and Triffin's dilemma. All right, you put those two together and you're going to realize, oh crap. No, like, you don't want a gold standard. You want gold in your possession. You want gold and silver in your possession, but you do not want a gold standard to exist here in the United States. If we were a manufacturing powerhouse, I would totally see that differently. I would say a manufacturing powerhouse where we produce the world's greatest stuff and send it out there to the world, and the world would send us their gold. Hell yeah. I'd be totally down for that. You bet. But we don't manufacture enough. In fact, we are in trade deficit, which means we import a hell of a lot more than we export. And if we're importing stuff, we are exporting dollars. And right now, we send out fake fiat paper currency with an empty promise to pay into the future with more empty promises to pay. If we had to switch that to gold, done. We are done. Out of the game. Over. There is no alternative to USD being the reserve currency of the world, not a chance for anything else. I totally agree with that. Not that I like that. I don't like that idea, but it's just the case. There's no way that you're gonna find anything else out there that can compete against what the dollar is doing. Even if you say it, oh no, these other nations out here can do it. They can't. There's no other nation out there that is going to be able to issue out a safe and liquid asset like the US Treasury debt to the level that the United States has done it. We're the greatest debtor in the history of the world. Like, there ain't nobody who's going to take on that much debt and issue out that much safe and liquid asset like the U.S. Treasuries and have the confidence behind it. I mean, think about it. Nobody even likes the dollar now. Are you going to trust any other country out there to do what the dollar is doing? They're like, you know what? United States, you guys suck. China, you take on, hundreds of billions of dollars worth of debt and issue out, trillions, not even billions, hundreds of trillions, like take on hundreds of trillions of dollars worth of debt, because that's essentially what it's going to end up being. And you're going to have the confidence of the entire world that you're going to be able to pay that stuff back. China, you're up, right? People are not going to they're not going to put their retirement into the Chinese yuan. They're not going to put it in the Chinese debt. But they do put it into U.S. Treasury debt. The whole world does, and they don't even like it. They don't even like it. And so there's going to be some other country up there that says like, oh, hey, man, we're way better than the United States at going deep into debt to the level that they're doing it, and we're promising we're going to pay it back. Like, nobody trusts anybody else like that. They didn't even really want to trust the United States. They just didn't have any other choice. Yeah, they had a choice, but the choice was either don't work, don't eat, or do transactions in dollars. Wonder which one they're going to end up doing. Probably transactions in dollars, right? And that's what happened. All right, you can't even buy BTC without dollars. Bitcoin and gold are essentially the same thing when it comes to the economic forces that are at play. There's only a limited amount out there. Right? The most industrious nation who decides that they're going to take Bitcoin or gold or whatever that's limited out there will produce the world's great stuff, send it out there, export their items and import Bitcoin and gold, hoard it for themselves, depriving the rest of the world from being able to do transactions. That's what happened with the United States and the dollar and the gold when we severed ourselves from the gold standard. And it's the same, like we produced the world's greatest stuff, sent it out to the world sent us their gold, and when it was time to redistribute it back out there to the world, we said no. We're going to keep it. No. Right? And if you want to do transactions, you can do it in fiat currency. We promise. We won't print too much. We promise. And then we print too much. Right? And now people are really pissed. But now they're stuck. Right? They're like, you promised you wouldn't print too much. And I'm like, yeah, sorry about that. Yeah, but what else are you going to do? Because you don't have any other choice at this time. All right, what if Bitcoin gets cut down into Bytecoins? It doesn't matter. It's still a limited coin, right? Like, I have one Bitcoin. If I never relinquish it, then there's only going to be, right, 20,990,000. Like, everybody who hoards onto the Bitcoin and doesn't relinquish it out there limits the amount of Bitcoin that's available to do transactions with out there. Now, yes, you can divide it into tiny pieces, but let me give you an example. I'm going to sell the Suburban for one Bitcoin, right? I mean, obviously that's way too much, but I'm going to sell the Suburban for one Bitcoin, but then the Bitcoin starts getting used and hoarded away, so there's not as much Bitcoin out there available. Well, now I can either wait for somebody to buy this Suburban with one Bitcoin, and every day it gets hoarded away, it makes this Suburban more and more expensive, or I have to start dropping the price of the Suburban in order to get it to be sold. So basically it's a deflationary currency. I put a price tag on a TV, I'm a shop, right? I'm a store, I got a price tag on a TV, $100, but the deflationary currency keeps hoarding the currency away from the availability to do transactions with. I can't sell my TV unless I start discounting it over and over and over again. So I buy it for $100 worth, or essentially for one Bitcoin, but then I can't sell it for one Bitcoin. I have to sell it for a half a Bitcoin as time goes on, and it hoards even more. I have to sell it for a quarter Bitcoin. I'm losing money. Why would I even have a shop? Why would I even do business? If I'm in a deflationary currency, screw that. I don't want to participate inside of this economy. Now, when it's on the upside, right? When the business transactions are happening and we're on the upside of the business cycle, hey, it's great, man. Yeah, I'll hoard up all that Bitcoin. But once it's hoarded away, then the transactions stop, and unless I redistribute that Bitcoin back out there to the rest of the world, we're going to have a very slow, dead economy. And this is the business cycle that most people were devastated with when it came to the gold standard. This is why they actually sold the central bank to the people was that they were going to smooth out the business cycle during the times in which that the economy heated up and there was a lot of transactions happening and people were hoarding on to that gold. They would start injecting paper currency into the system to keep the economic activity going. Right? So as the economy heated up, they would inject money. When the economy slowed down, they would pull that money back out. This was the elastic money supply that the Federal Reserve was going to try and maintain and try and smooth out that business cycle, but it totally didn't work, right? Because they take advantage of the situation and print too much money. But that was the idea. That was the selling point behind it all. Once you see it, there is no good currency that is going to be like the awesome currency for everybody to use and it's like, perfect for everyone. It doesn't work like that. It's better to understand the system that we are in so that you can position yourself for it. If we were in a gold standard hard currency situation, I would be hoarding on and saving as much money as possible, and I wouldn't even stress investments because I know that by hoarding on to that money, it would actually create a situation in which that the buying power would just only increase every time I hoarded it away. Other people would recognize that too. Business activity would slow down dramatically. I mean, once you have issuance of debt, well, now somebody's idea of starting up a pizza parlor, they can go and borrow money from a bank, get that idea off the ground and actually make money with it. If you're in a gold standard, well, then you have to really find somebody who actually has the money. And banks are very tight with it. Their interest rates are very high. It's almost like having to go and get private money from somewhere. But if you have a banking institution like the United States and the fiat currency, where you can just essentially issue out as much debt as you want, well, now somebody's idea can come to fruition really easily. Now, granted, it also sets the people up that they produce these wonderful, beautiful products, and then when the interest rates rise and they can't make the payment on it anymore, it ends up getting sold off to the rich for pennies on the dollars. But that's kind of the consequences that you have to pay in order to be in this game of easy flowing financing. It's just kind of easy like that. All right, what time is it? I got a few more minutes here. Let's cruise down. 619 people watching. I'm loving it. Thank you so much for joining in on today's live stream. Be sure and hit that like button. We also have the podcast up and running, so be sure and hit the link down in the podcast. Go and check that out. Subscribe, comment, do whatever it is that you're going to do with the Spotify thing. In order to get some attention for that, we are trying to get that up and monetized, so that it's another channel of revenue for the Uneducated Economist. And I know a lot of people would rather listen to these than watch them on YouTube, so they're available on Spotify now. There's a link down in the description, so please, if you're watching this video, go and hit that link and check out the Spotify page that we've got going. Thank you, All Nighter, for posting it too. All right, I own tons of guns. When the stuff hits the fan, you are going to be trading in things people can use. Bitcoin, WTF is that then? Here's the problem that I think a lot of people end up having. When they rely on their firearms exclusively, don't get me wrong, I think it's a great thing to have, great thing to own, great thing to know how to use, and I believe that, the possession of firearms is a wonderful thing for us to have here in the United States as a right. Here's the problem. Counting on that for end times is going to be incredibly horrible for you, because what you're going to have to do is you're going to have to fight door to door for survival. And when you come across people like me, it's not going to work out very well. In fact, most of the people that I know here that in my community, I just don't believe that would end up being a very effective way of going about it, because just about everybody I know has firearms, right? Like literally everybody. And that's what I find funny about it. People are like, oh, dude, you're just from the West Coast. You don't know anything. You guys are a bunch of liberals out there. And I'm thinking, we're a lot more freedom-loving, libertarian-minded people out here than you could ever possibly imagine, And that's, and that's what I find comical about it. People they watch Portlandia and think that's how the people really, well, actually, it's pretty accurate to how a lot of people behave. I shouldn't use that for an example. But still, that's the way they think everybody up here is, and that's simply not the case, All right. So U.S. exporting dollars and the world taking or giving loans in dollars devalue our spending power. Am I correct or half correct? Well, in a sense, yes, right? Because when you are issuing out debts outside of the United States, when these nations, countries, corporations, people are writing out a loan, right, that is due in dollars, they are creating a contract, an instrument of debt that is dollar based. It doesn't have anything to do with the United States, not our people, not our government, not our companies, corporations, banks, nothing. It doesn't have anything to do with the United States in any shape or form, but yet it does involve the use of the dollar. So once that contract is created and is loaned for dollars, not only is the dollars that is loaned existent, but then that contract itself starts getting used as dollars, right? It's like an IOU that does transactions within itself. So this is creating dollars outside of the United States. When that contract disappears, the dollar disappears. So you can imagine that if people were getting out of the dollar denominated debt, those contracts are going to disappear from the world. If there is less contracts that are dollar denominated, those things are getting used like dollars. That's less dollars that exist inside of the world, and that strengthens the dollar. As people are literally getting out of the dollar saying, I don't want to participate in this anymore, it causes the dollar to strengthen because they are getting out of those dollar denominated debts that existed or were created outside of the United States. So as those debts disappear, so do the dollars. So do those, essentially euro dollars. All right. The collateral in that contract is what backs the dollar. The dollar is rescuable. It's not that far gone. I disagree, like in the idea of rescuable. It's either works or it doesn't work, right? And so it either has the confidence or it doesn't. Rescuable would mean that you either build confidence or you lose confidence. That's it, right? There is no other way, because the dollar itself is essential is nothing. It is it like, you have to think, the Federal Reserve prints these things up with a backing of U.S. Treasury. So they have a balance sheet just like anything else, any corporation or anybody, with assets and liabilities. The assets are like mortgage-backed securities, special drawing rights, gold, and especially, for the most part, it's U.S. Treasury debt. The liability is all the dollars they create. So when they create these dollars, it's backed by U.S. Treasury debt. So dollars are backed by a promise to pay into the future. That's it. And a little bit of gold, SDRs, mortgage-backed securities, but essentially there's no real anything that's backing the dollars, because there's certainly not enough gold to back all the dollars. Here's something that's really interesting that I don't think a lot of people know about the Federal Reserve note. I'm going to share this with you, and then I'm going to call it quits for the day. But this is something interesting about the Federal Reserve note itself, is that a Federal Reserve note is a first lien and paramount right to the Federal Reserve Bank's balance sheet. All right, so now this is something interesting to think about. If there was a collapse of the system, a collapse of the banking system, the Federal Reserve goes bankrupt, right? If you have Federal Reserve notes, like Federal Reserve note paper dollars in hand, not a bank account, not something that says like I have a stock portfolio with this much money in it. I'm talking the Federal Reserve notes themselves, the paper bills. Those are the first lien paramount right to the Federal Reserve's balance sheet. So if they go bankrupt, you show up with those Federal Reserve notes, the paper dollars themselves, you have the first lien right to whatever on that balance sheet, with gold, SDRs, U.S. Treasury, all the other stuff. Well, if there was a collapse of the whole Federal Reserve system, there's probably not a whole lot on the balance sheet anyway, and I doubt you're going to be able to go and claim anything with your Federal Reserve notes. But the point being is that it's worded in that fashion, that those have the first lien and paramount right to the Federal Reserve's balance sheet in case of a bankruptcy. So something interesting to think about, like those Federal Reserve notes hold a little bit more power than just having a bank account with dollars in it, or essentially what is assumed to be dollars in it. When you hold the actual Federal Reserve notes themselves, you hold a different position than a bank account holds, right? Because you have the first lien paramount right, your bank account doesn't. If you have the paper dollars, you do. All right. Stocks and bitcoins are horse crap, okay, in my opinion, and should only account for like 25% of your investment, if not less. Bonds right now have a higher return than the S&P 500 aggregated. Okay, man, this was a lot of fun. I really enjoyed coming out and talking with this one today. Kind of rambled a little bit, but I think it was some pretty good topic to discuss. We have 618 people watching with 155 likes. Thank you so much for hitting that like button. By hitting the like button, you get the YouTube algorithm to pick up the video and spread it around for more people to see. By commenting, it shows engagements, so the algorithm loves engagements, but it really, really, really loves sharing the video. When you share the video, that's when the YouTube algorithm really starts to spread this video around for more people to see. Supports the Uneducated Economist. And again, go and check out the Spotify link that I left down in the description to the Uneducated Economist podcast, where we're trying to build up some audience over there on that. So thank you very much for being here. Uneducated Economist, links are down in the description. You guys let me know.